The purpose of Wealth Talk is to educate, inform, and hopefully entertain you on the subject of building your wealth. WealthBuilders recommends you should always take independent financial, tax, or legal advice before making any decisions around your finances.
Today's episode is brought to you by WealthBuilders Membership, a proven step-by-step process that helps you achieve financial security within 2 to 3 years. To find out more, head to wealthbuilders.co.uk/membership.
Hello and welcome to another episode of Wealth Talk. I'm Kevin Whelan, founder of WealthBuilders, and I'm joined today by a great friend of WealthBuilders, Manish Kataria. Welcome, Manish.
Thanks, Kevin. Great to be here again. Yeah, always a pleasure.
Well, you know, we were chatting and we thought it would probably be interesting to share kind of the wider sense of investing, but not specifically stock market investing, but all the different choices that individuals and businesses and families can make as investments. And given the uncertainty of the world right now, there's lots of posturing for positioning of leaderships in government parties. We've got posturing across the pond between Israel and Iran and the United States. And these are putting pressures on things that are seemingly out of our control. As we're definitely seeing an increase in, for example, the cost of government borrowing. Gilt rates have started to nudge upwards. The government, the Bank of England rather, Bank of England is supposed to be independent of the government, talking about possibly, next move would be on the up as opposed to on the down. So as we're living in a sort of a more unpredictable environment, and certainly as far as I'm concerned, wealth is the process of creating as much certainty as possible in an uncertain world. I thought it would be good for you and I to have a bit of a investment riff, to chat about all the different markets and what people can do to be more financially fleet of foot, more in control, more making decisions by intention and on purpose than being buffeted by what's going on in the world. What are your thoughts about that?
The simple answer, but not very common, is to be balanced and diversified. That is always, I always come back to this concept of being balanced and diversified. That is the ultimate, sort of mitigation for, random things that are going on in the world. And by their nature, these things are unpredictable. So you can't always prepare for, what's about to happen, particularly when you've got, crazy operators, in place, as there is at the moment. So there's lots going on and, macro themes, economic developments, political developments. I think you need a more holistic approach. I think you and I were talking about that earlier, weren't we? About needing, a greater level of sort of, planning and holistic planning around your portfolio. And that involves multiple asset classes, not necessarily just the stock market, not necessarily just property, right? And certainly not necessarily cash, because that's, in many ways, the most dangerous asset class there is.
So why do you think it's dangerous? Most people think cash is safe.
Yeah, and it's ironic.
They're looking at, I suppose.
Yeah, it's ironic because, cash gives you a full sense of security. Cash is, if you look back over decades, centuries, the worst performing asset class, the major asset classes, the worst performing asset class has been cash. Any other sort of, we call them risk assets. So whether it's property or stocks or, any other real assets have outperformed. And the reason for that is because there are two reasons. So interest rates are historically lower than the rate of return on stocks and financial assets. And the other thing is inflation, right? So inflation is the silent killer of wealth. And most people don't realize the dangerous effects of inflation if you hold on to too much cash for too long a time period. And so you have the official rate of inflation. And that's one thing. I think we are being led to believe it's something like 3% at the moment, right? Historically, inflation rates have always been understated. And there's lots of evidence out there to show that actually the reality rate of inflation is more like what we hear, plus 3 or 4 or 5%. So right now, I genuinely believe the real rate of inflation is more like 6% plus. And, I don't think anyone really believes that their cost of living is increasing by an annual rate of 3%. You just have to look around what you're spending money on. It's much more than that, right? And there are lots of reasons we can explore why that is the case, but that is reality. And there are lots of studies to show that is the case.
But coming back to I'm going to give counterpoints to your arguments, right?
Sure, yeah.
Not just to be conflicting, and I'm not going to conflate issues either and mix things up. But I think there are reasons, and I think you caveated it, but it was in half a sentence, which is too much cash. So in the context of too much, you have to understand what's the plan, because too much or too little depends on what you're trying to achieve. So if, for example, you're trying to buy a house, the house of your dreams, and you need money in cash to be able to buy it, you might need more cash temporarily in order to do that. So where are you on the issue of how does someone identify in this broader feeling, or even if it's an illusion of security, in the same way as employment can be an illusion of security, and we talk about wealth being creating assets, and jobs are not assets, but so many more people are in jobs than in business. But how do you go through with the people that you share your wisdom with, how to choose the right balance and the right amount of cash? What are the ingredients in that discussion that says you do need to have some cash, but this is how you might want to think about it? What's your view on that one?
Yeah, it's a really good point. So look, cash can be incredibly useful, right? So for liquidity reasons, and if you, the example you gave, if you're looking to buy a property, of course, you shouldn't be going out and speculating with that cash that you will need in 6 months' time. So in a steady state, in the long term, what I say to people is you shouldn't hold on to too much cash for too long a time period in a steady state, right? And what does that mean? So look, let's disregard the known need for your cash in, say, 6 or 12 months' time for whatever reason. If that's all gone and there are no reasons to be holding on to liquidity, as a percentage of your overall portfolio, don't own any more than 5 to 10% of your cash, of your wealth in cash, right? 5 to 10% is your sweet spot, depending on how cautious you are, because it's pure arithmetic, right? The historical track record of returns on your cash is much less than the historical track record of returns on other real assets. So 5 to 10%. Alternatively, another way of looking at it is if you are, if you look at your monthly expenses and you identify 3 to 6 months of your monthly expenses and hold that amount in cash, because if something was to happen, if your income dried up, if you lost your job, then at least you have that sort of 6 months of runway ahead of you. So that's probably how you should be looking at it in a steady state.
Okay, so let me take a different point of view. What if I'm really interested in, well, two things. Let me give you two alternative questions just to see how you would approach that. So one is, I'm getting close to retirement. I'm worried about sequencing risk, the risk of the markets crashing within a very relatively short space of time of my need for income. And assume I've got money in a pot type income, not money in a defined benefit, not guaranteed income. And I'm just nervous about the world. And I think 3 to 6 months just ain't enough.
Yeah, another great point. So there are still better asset classes, safer asset classes than cash. There are better returning asset classes. So look, you still go with that sort of 5 to 10% of your portfolio in cash. Let's say you're approaching retirement. Let's say you're, 70 years old and you're approaching retirement. Your main sources of income are maybe looking to dry up and you're looking to live off your pot. So the approach I favor, and, you mentioned sequence of returns risk, and that's really important because, in the early days, if you've got a pot of capital which is working for you, you don't want to be selling off assets in order to fund your lifestyle. So how do you get around that? So you have some cash, 3 to 6 months worth of cash, and then you have some other asset classes, safer asset classes. So short-term government bonds, which give you a little bit more than cash, but actually have, virtually zero default risk. You have money in money market funds. Another approach I really like is holding on to safe blue chip, high quality high dividend stocks. And the reason I like that is because your listeners will be aware of the 4% rule. Essentially, in a nutshell, you can have a pot of capital, and the idea is that you can extract 4% per annum in order to fund your living expenses with a minimal risk of that money ever running out. So the problem with the 4% rule is you are looking to sell down your assets as you go along in order to extract the 4%. Now, if you are owning a fair amount in high dividend stocks, what happens is that you can essentially live off the dividends. You can live off the dividends to fund your lifestyle, and you can get some really interesting high quality blue chip dividend stocks which return 5%, 6%, 7%. So if you've got a good portfolio of high dividend stocks, you can live off the dividends, and you can let the capital values of your stocks, fluctuate over time. And historically they go up over time, but yes, they will fluctuate. And the final thing to mention about this, Kevin, is the reason why this is a good approach is that if you look back historically, dividends tend to be more stable than capital values. Capital values fluctuate in the short term. Historically, they appreciate 8 to 12% per annum. But dividends are, they're known to be more stable, and, they're very rarely cut. And when you own a portfolio of high dividend stocks, the average portfolio, the average dividend tends to grow even during recessionary times.
All right, well, we'll come back to that, because before we finish on cash, there are a couple of other points I want to share with you. So one of those is I was reading a report recently, and rather than kind of give the detail of the report, it was the fact that so many business owners who are focused on the trading entity of their business itself. So, businesses that are providing goods, services, rather than a property business, are holding on to cash. And more than 50% of business owners are not shopping around to get a higher return. And, if depending on how much businesses have got sitting on their balance sheet in cash, there seems to be some natural phenomenon that holds back founders and creators of businesses to be shopping around and looking to get a safer return by not having too much money in one bank, because we've got banking risk, and an investment return that we were chatting, and it's not unusual for me to see a business when I meet them to have £1 million in cash. And if they can get 4.5% on a fixed interest, even cash, that's 45 grand. And 45 grand could pay for a member of staff, or could pay for a marketing program, or it could pay for a whole host of things they don't pay attention to. So I know your focus is investment, but they could invest that money as well and create an alternative income stream and start to build knowledge and experience around investing. So what's your take on that one?
Yeah, and it's a very common thing. I see the same. So when I work with investors, many of them are business owners, and you know what it's like when you're a business owner. Your focus is on your business, right? And so the investing the surplus capital, which will build up over time, sometimes becomes an afterthought, and it's also a function of not necessarily knowing what to do with it. I really believe strongly that as business owners, as directors of a company, it's our duty to try and create the maximum value for our shareholders. And now often that happens to be the director's own. The director is the shareholder, but it doesn't matter, because as a director of an official limited company, it's your duty to create the highest amount of value for shareholders. And so if you are just letting that cash just sit there, earning next to nothing, I don't think you're fulfilling your duty. So you can be doing a lot. You can be investing that money. At the very least, interest-bearing accounts. What we do is we put, some of that liquidity into money market funds, because money market funds give you great rates of return, or at least matching the base rates with zero notice, great liquidity, next to no risk. And then you can invest that money also into, dividend stocks, into diversified funds, into all sorts of assets.
Yeah, business can do that. There's just an assumption that businesses don't know how to do that. I mean, some of the language, and I think it's important to share this with our audience, because they can be from different backgrounds. They could be known to wealth builders. They could be experienced investors or novice investors. And I think it's our duty to minimize the confusion and to maximize understanding. So I think everybody who would be listening would understand banks and institutions will provide a return on cash. I don't think we need to explain that. I think it's useful to explain that the whole banking industry is predicated on the margin that they can make on reinvesting that cash, which is normally in the form of lending. However, I don't think people know about a money market fund. I mean, what's the difference between cash and a money market fund if you've never heard of a money market fund?
So cash, you're investing with one institution, and they, as you exactly said, they lend that on to somebody else. A money market fund is essentially a fund consisting of a diversified range of high-grade issuers. So what you're effectively doing is you are investing your money into a fund which then lends it on to the UK government. High-grade corporate borrowers like Tesco or, blue chip organizations, AAA rated, typically organizations who are looking to borrow short-term money on a secured basis and will give you rates of returns comparable, slightly higher than short-term government bond returns. So essentially, in a nutshell, these types of funds are highly liquid. They are diversified. You're not just lending money to one entity. You're typically lending money to the government and other high-grade borrowers. And they've never defaulted, right? So even during
government's never defaulted. You can't say a corporate bond has never defaulted.
No, money market funds have never defaulted, because these bonds, these short-dated bonds that you are investing into are super high grade and secured, backed by corporate assets. They're all AAA rated. So yeah, there is virtually no risk. We've never had money market funds gone wrong. So that's what you're investing into. And in many ways, that's safer than cash, because in my view, if you're saving some money with a bank, you're protected to a certain extent, right? You've got the SSAS guarantee for what that's worth in the case of, everything going south. But yeah, so in many ways, because these are diversified, because you're lending to the government as well as other high grade borrowers, in many ways, they are, money market funds are safer than cash.
And so given that we've got two different thoughts going on in that same conversation. One is lending money, or money being used by institutions who are corporate, so they're profit related, and the government, who are always issuing notes for individuals and companies and countries to lend them money in exchange for a rate of return known as a coupon. What is your view of the difference between lending money to a corporate client with whatever risk rating is performed on them and lending to the government, bearing in mind that gilts also operate slightly differently in terms of capital gains? So what are your thoughts around that?
All else being equal, you'd rather lend money to the government, right? Because there is, in theory, zero risk. With these corporates, you're getting a slight yield pickup. But as I said, they are so senior, that the debt is so senior, it takes precedence over any other debt. So, there is virtually zero risk of anything going wrong. So, I like the diversified approach. And I also like with money market funds that there is zero notice required, right? So unlike other savings funds, you can be parking your cash in a money market fund today, and you can take that out next week without any penalty.
And how would people access that? Where do they go to look at these things to to make a sort of a relatively informed decision by reading, watching, listening, whichever way they want to learn, so they can go, oh, I've never heard of a money market fund. Where would I go to start learning about that?
Yeah, there are lots of providers. The one I'm invested in is issued by Royal London. Royal London is the fund operator. There's a Royal London short-term money market fund. You access these things through platforms like, the sort of AJ Bells of the world or Hargreaves Lansdown or whichever platform you are with. So they're pretty easy to access you need a platform. You need an account. So if you're investing through your limited company needs to open up an account with one of these platforms, and then you can just buy it like any other fund or any other share.
Yeah, it's like a supermarket, really, isn't it? In the same way that you would buy goods in a conventional supermarket, you're able to buy not just money market funds, but a wide range of traded funds within that. And are there different complexions in your view? You mentioned a few, but many exist. Any that what would be some of the features that someone looking at a platform would need to look out for to make an informed decision?
There are lots of different parameters, costs and what kind of accounts they offer. And, some offer funds, some offer only stocks or ETFs. So there are lots of different things. But, I think cost tends to be one of the biggest things. And the cost isn't the same for everybody, right? So if you are looking for a platform, it depends on how much you're investing. So there are a few different parameters. In terms of money market funds, I think there are two things you should be looking for. One is it should be a sterling money market fund because you don't want to be taking on currency risk. And the second thing you should be looking for is a short-term, it would be in the title, a short-term money market fund. So you're not taking on interest rate risk, right? So you are investing at the short end, which makes your money even safer.
That was an interesting take. And I definitely think that there's a point worthy of note, certainly when it comes to both cash and platforms, that it is possible. As wealth builders, we focus increasingly now on families rather than individuals. And so it's easy to give advice to an individual. That's what a typical advisor would do. But looking at a whole family means you can aggregate. So it's possible to look at across a whole family and say, well, if this member has got this member has got that, and you add it up across a blended and different generations within a family, you can either get a higher interest rate on cash because of that aggregation, or a lower interest rate, a lower cost on a platform by aggregating money on behalf of a whole family. And we look at that aggregation when we're talking to the families and say, well, if the whole family wants to invest in markets, and most do, because there's, like you and I both agree, there's room for markets of all kinds. And so why not look, if you have a wider family, to see if you can't bring some aggregated benefit to that. So very useful. And I guess we'll touch on the microcosm of that on SSAS if we get a chance to talk about that, because not everybody would qualify for SSAS, but pretty much all families would qualify for some form of aggregation. Let's have a chat about gilts, just generally, because there's clearly pressure on the government. It costs them more money to borrow. So the rate of return or the coupon on gilts is getting increasingly higher, which means should be worthy of a discussion or a review. What are your views on pros and cons of holding gilts?
Gilts have a place, within our portfolio approach. Our portfolios have a GPI framework. So I think all portfolios, any good balanced portfolio, should have an element of growth, protection, and income. Those are the three essential ingredients of any good portfolio. And for us, within our P bucket, within our protection bucket, gilts have a place. I think gilts, or bonds in general, you should position yourself depending on how cautious you are. So historically, bonds have underperformed stocks, right? So, but on the other side, they happen to be more stable over time, right? So it depends on how much it depends on your risk profile. It depends on, to an extent, your age. It depends on, how close you are to retirement. There are lots of different factors for you to take into account as an individual. I think gilts, you're lending to the government, but gilts tend to have longer maturity periods. So let's say you buy a 10-year gilt today, you know that there's a 99% probability that you will get paid back all of your money in 10 years' time because you're lending to the government, and governments generally don't default. Not always. Generally, they don't default. However, that's only if you hold on to it for a 10-year period. If you then decided actually year 3, year 4, you want to get out, there's no guarantee you'll get back your initial investment, because in that 10-year period, market values fluctuate, right? So you get your coupons, that's for sure, your annual coupons, you'll get those. But actually your capital values are only guaranteed once you get to maturity. So that's the sort of potential downside. And again, historically, gilts have returned less than stocks over the long term.
There's definitely a role for baskets of gilts, so not holding one gilt for 10 years, for example, because it's possible to buy the discount gilts that have got a shorter maturity date. But you need guidance, I think. And there are plenty of guides about the buying and the selling and the creation of a portfolio. And just as there are fund managers and IFAs who look at helping you create a level of funds involvement linked to your attitude to risk, it's possible to do the same with gilts as well. And certainly for higher rate taxpayers, for money held outside of a pension, there's some capital gains benefits there, because the difference in the value in terms of the price, if you buy something at 90p and you get the original stake back at £1, then you're getting that capital gains tax free. So your tax position, albeit isn't something we talked about specifically, because otherwise it get too complicated, wouldn't it, if we talked about everything. I think we'll touch on inheritance tax a little bit later, because I think it's important generally to involve the next generation in thinking and understanding and learning things as well as ourselves. But I think we started talking earlier on with most business owners spending no time at all, even just trying to get any interest on their cash, let alone spending time learning about bonds and gilts and so on.
Just finishing off on the gilts, the really important feature of gilts is this, that you don't necessarily buy gilts or any type of bond. Of course, gilts are UK issued bonds, and then there are bonds issued by the US, etc. So you don't necessarily buy government bonds for the returns, because, as I mentioned, they underperform stocks. The real reason you own bonds is because in a portfolio context, they tend to move in an opposite direction to stocks. So when there are times when stocks are selling off, if there is a recession, if there's some sort of issue going on, historically bonds tend to go up and stocks go down, and vice versa. And that's why within our GPI portfolio, they work really well to kind of provide almost a hedge to your stocks.
No, interesting. And that was your broker just telling you to buy, was he?
That was my broker. Yeah. We need to buy bonds.
What about, there's a lot of talk about this sort of broader economic pressure in the world, and the price of gold, and what does gold do, and what should it do, and what role does it have in an overall diversified portfolio? Any thoughts on gold?
Gold is part of our protection bucket. And in many ways, it's similar to bonds. It gives you that protection in the event of some, crisis. It's a fair trade beneficiary. And gold has had a phenomenal run over the last 2 or 3 years. It's done really well. It's taking a bit of a pause for breath at the moment. But yeah, look, it in many ways, it performs like bonds in that it gives you that protection when something bad is going on in the world.
Yeah, albeit it doesn't provide any form of a yield.
It doesn't give you a yield. Yeah, that's the sort of downside. You don't get a yield. Having said that, when we are, and we might get a chance to talk about options later, what we do is within the options asset class, we can create an income stream out of gold. So we own gold on the one hand, and we can rent it out for monthly income. So you can, in some ways, create income from owning gold.
Yeah, well, in the same ways you can create an income from owning any asset, really, because if you own it, then there are other people who might want to own it as well, for whatever reason we do that. We'll definitely talk about options, I think. It's an area that probably people have heard about, but don't really know too much about. And I think you've got a really nice way of articulating and helping with that understanding. Bear in mind that, of course, neither you nor Wealth Builders dispenses on a podcast any kind of financial advice. You should always take professional, tax, legal, or financial advice before making big changes with your money. However, I think empowerment and understanding doesn't always have to come from somebody who's being paid to manage your money, because, as you said many times before, the best people or the best person to take responsibility for your money is yourself. And I think I applaud your desire to empower people to be more in control rather than simply being on the receiving end of a fund meeting or a fund discussion with a considerable amount of money being lost in fees. And by the way, on the cash thing, I was noticing recently that some of the platform providers, where there is cash held on the platform, they're actually double dipping. So they're taking money as a percentage on the fees, but also helping themselves to a bit of interest on the cash as well. So when you choose a platform, be specific about, do they charge a share of the interest that they make on the platform? Because this double dipping is something that I think is counterintuitive to good investing if you're allowing someone to have two bites at your cherry, which means by definition there's less cherry left for you and less cherry left for your next generation. And if you keep letting people bite your cherries, you're not really going to be that good of a teacher to teach wisdom on to the next generation. But anyway, how about chatting about this broad approach you take to the G section of your description, your growth section? Talk to me about how you suggest people go about the thinking of that construction.
Yeah, here's the thing. Most people build their portfolio the wrong way around, right? So the average investor, if you look, I get to work with lots of investors. When I see how they've been investing until, we start to help them. If we look at their portfolio, it's typically sort of, there's no process behind it. So, it's a bit like, it's a bit like sort of, I liken it to building a house, right? And so what most people do is, if you think about buying building a house from ground up, right? You wouldn't necessarily buy the light fittings to start off with, right? You wouldn't buy the chandeliers before you poured the concrete, before you poured the foundations, right? That's what you do. You need to be, when you are building a house, you need to be designing the house. You need to be creating the foundations. Then you need to build a core, right? Where most people sort of start the other way. They buy individual stocks. They might buy a little bit of crypto. They might buy a fund because they've been recommended it. And what happens is that they're left with a sort of portfolio, bit of a mishmash portfolio. And even worse than that, they end up with a portfolio that they're not quite sure about the risks. They're often doubling up on risks. They might have too many tech stocks. They might have the S&P 500 index because they heard it's the right thing to do. They're not balanced properly and they're doubling up on individual risks. So most people start, by sort of buying the light fittings first. What we do is we start with the foundations. We start by designing your portfolio, asking people, what's your risk profile? What are you looking to achieve? What is your time horizon? Minimize your fees, inflation and taxes, minimize your fits. All of these things that come before you've even started to, invest. And it doesn't take that long. It's not that complex, but you just need to be aware of that stuff before you start building your portfolio. So that's the one thing I would say is kind of be aware of build your foundations first, build your core, and then there is nothing wrong with buying individual stocks, buying a bit of tech, buying some AI stocks, buying some crypto. Nothing wrong with that, but build your foundations first. We call it our core and satellites approach. So your initial diversified set and forget stuff is your core. That stays with you for life pretty much. And then your satellites are fun things like individual stocks and crypto, etc. So that's what I would say. That's the biggest sort of observation and advice I would give to people, is start at the right end rather than sort of, building out your satellites first.
So, and I share the view with you about fees. So just the same as taxes, they can quickly eradicate some of your returns. And I just touched on that with a cherry biting analogy. But what I've found to be the case is people don't know where to start. They don't know where to find out about the fees. They don't know who to ask. They think they're hidden on page 23 somewhere in the small print. What's your approach to helping people really get to grips with the fees? And then we'll ask about how you deal with what's your attitude to risk. Well, you don't know what your attitude to risk is unless you're giving some kind of metric in order to establish that. So let's deal with the fees first. What's your process of helping people understand the clarity of what the fees actually are as part of that foundational build?
Most people aren't aware of how much fees they're giving away. And so if you have money in a work pension scheme, an old work pension scheme, current work pension scheme, if you have your money being managed for you, you really need to be aware of all the sort of the layers of risks, the layers of fees that you are paying to your provider. And quite often you don't get told the whole picture, because not only are the fees high, they tend to be hidden in different layers. So broadly speaking, there are 3 layers of fees you should be aware of. And by the way, if you've got a work pension scheme, it's not as benevolent and charitable as you might think, right? It's a cost center. You are paying fees for professionals to be managing that money for you. So there are 3 layers of fees. One is the overall scheme fee. Whoever is operating your overall fund, your work pension or your IFA, your wealth manager, that's your overall scheme management fee. Then there is the amount, that your money is being invested into funds, right? The underlying investments themselves have fees, right? And they're often hidden because they're not explicitly stated, right? So that's another layer of fees. Then there are fees related to the platform, because you need platforms to hold your investment. So we've already identified 3 layers of fees. There are multiple other layers of fees. And overall, individually, they might amount to, 0.4, 0.5% each, but in total, they could be 1% plus. And even then, you might think, okay, well, it's only 1.5% per annum. That doesn't sound like much. But when you compound that over time, if you're holding on to these things for 20, 30, 40 years, that could be a significant amount of your overall capital that you are paying away to somebody else. So I always say, be aware, fund your retirement, not somebody else's. And really the key thing is ask your provider, go up to them and send them an email, or, pick up the phone and say, well, look, I want to know each of these 3 layers of fees, and I want to know what they total up to, and I want to know them individually, and they will have to give those to you. And then you just have to do a compound calculation over a period of 25 years and see how many tens of thousands, if not hundreds of thousands, that will, extract from your capital that you could be using in your retirement. We've helped people save tens of thousands of pounds, just through a sort of simple review exercise doing that.
And it's so incredibly important because, as you say, sometimes the sound of, it's only 1.5%, it's only 2%. It doesn't sound like a lot, but if the average, you talked a minute ago about the 4% rule. I don't agree with the 4% rule, but let's not go into that debate. But even if you did, if you're getting 6% on your money and paying 2% in fees, there's a third of your money gone. But it isn't. It's a lot more than that, because if you've been doing that for decades on the bill, then that money got paid, so it didn't get a chance to compound. And then that money comes out of your income at retirement. And what's interesting to me, and I'm a true believer like you are, of just being aware, because when you're aware of something, you've always got 3 choices, but it's up to you. So if you've got awareness, so say you do a review, whether on your own or with help of someone like you, and you say, well, look, I'm paying 1.5%. Okay, I'm paying that. How do I feel about that? Well, compound calculator, maybe you've got a link to one that you could share, or you could tell us where to get that. It's not as easy just to do it. Somebody's got to calculate that, see the impact of that. And then once you've worked out the impact and worked out, is this person or these layers adding value or subtracting value? What do I want to do about it? Am I happy with that and do nothing? Am I not happy with that and this is what I can do, whether by empowerment, working with someone like you, or this is how I can get a better deal from the institutions that I already have a great relationship with, like aggregation, like negotiation, like being focused and saying, I want you to add more value. And certainly the FCA, who regulate these things, are definitely putting more questions about the efficacy of the tick box of an annual review. You may not need to do something that way, so why would you pay for it? I concentrate on these things, so I don't go to bed with a tax manual, but I do sometimes read some reports, and I saw one from the FCA saying the number of advisors who are charging bereaved clients fees. The clients already died, but they're still levying the fees. They don't shut them off because, well, you could work out the reasons, but they don't shut them off. And now it's another expose of what's going on. And I find consistently every year that I've been doing this work of helping people build, protect, and transfer their wealth, there isn't a single year goes by where some scam isn't being exposed of hiding. And my view of life is, if you've got creativity on your side, if you love finding more value or you can create more value, why not create it for the client and you can keep their business forever as opposed to creating it for yourself and hiding things? Anyway, that's a soapbox I'm now going to get off. But let's talk about options, because it's a subject that I know you're passionate about. It's a subject that demands a more creative thought process. So why don't you tell us what it is, how it works, and how it can bring more value if you're willing to learn a bit more?
I'm a big fan of options, and a lot of our investors are. Options are a really interesting asset class, and there's a whole big misconception out there. A lot of people think options are risky. They're really not. In fact, they are a lot safer. You can own stocks in a way that's a lot safer than just buying stocks in the regular way. So options it's an income machine. It's an income engine. We call it. It fits into the I in our GPI framework. So, remember every good portfolio must have an element of income. And in a nutshell, options allow you to own good quality stocks and rent them out. Not too many people know that actually you can rent out your stocks. You can own stocks in the way I said earlier. You can be owning gold and renting out your gold holdings through options. And you can do the same with stocks. You can do the same with bonds. There are lots of ways in which you can do lots of different asset classes. So we typically earn between 1% to 3% per month. That's per month on doing options. And so it's a way to rent out assets that you already own. That's one way of doing it. There are two ways of doing it. There is another way which, we can explore later, but in a nutshell, if you already own shares, or if you are looking to buy good quality shares, why not rent them out just in the way you rent out your property assets? It's a very similar concept.
And you're right. This concept which has been established for as long as trading has taken place, people covering their risk, which is, an important part of what options do, is covering risk and generating income. And of course, Mr. Buffett was, a great exponent of that. People think he just bought great stocks, but he didn't. He took incredibly significant positions on the amount of money you hold in stocks he liked, and said, well, if you want to rent them to use them because you want to speculate or you want to do something, I'll either sell them and make a profit, which is great, or I'll rent them and get a premium or a rental, and that's great. So either way, you're making money. So And in microcosm, you share and teach that, don't you, in the program that you operate. And of course, we're happy to tell people about that because, we think it's so important that all aspects of investing are understood so that when you understand them, you can make one of those three decisions. Do nothing, and thank you for the explanation, Manish, but it's not for me. Or, here's something I can do with a bit of guidance, or here's something that I want to build into my portfolio, and it's something that they want to do. And like anything, no matter how thinly you slice anything, there's two sides. So nothing is for everyone, but it's just great to spend some time to understand it. And we're happy that you share that because we trust your integrity in what you're trying to do rather than just trying to, flog a course to somebody to do something that they'll never only use once and never use again. So it's something that you want people to embrace in their life so it becomes a part of their overall investing, right?
Yeah, I think it's, and thank you for your kind words, Kevin. Yeah, we're always, at the end of the day, it's about helping investors take control. And you've said a few times, there's nobody will look after your money better than you will. And when you are aware of these different ways in which you can invest, it's not just about buying a stock and buying the S&P 500. When for options, we're talking about options now, if you can create income streams, and really attractive income streams, 1 to 3% per month is the equivalent of 20% plus per annum, right? And this is not a high risk way of investing. So, and it's a versatile way of investing. And we're doing this all the time, and you can do it in your pension. And I know you're a big fan of SSAS, Kevin. SSAS is a great vehicle to be doing options in because all of your income comes through tax free. And SSAS is all about taking control. And with options, you can do that in multiple different ways. So it's a really great asset class. When you do it properly, it's a bit of a learning curve to understand the mechanics of how it works. But once you've done it a few times, you'll love it. And not only is it financially rewarding, it's actually quite intellectually rewarding. A lot of our investors just are so passionate about options, just like I am, about, the miracle, some describe, how you can actually create income streams from assets that you already own. So it's really worth exploring. And if there is, if there's the opportunity to give people a report, a step-by-step explainer on options, I'm happy to drop that into the show notes if that.
No, we'll definitely do that. We'll give people, given I think it's a game changer. And of course, although you said options can be held within pensions, not all pensions will allow you to do that. So if you've got a workplace pension and you knock on the door of your employer and say, I've been learning a bit more about options from Manish Kataria, can I do that? The answer is going to be no. Similarly, anything that you hold where predominantly the provider is trying to make money from a share of your stocks, just like banks make money from share of interest, then the answer is likely to be no. So you'll need to know a little bit more. I think there's one that I know you use, and we certainly use them as well when it comes to stocks, which is Interactive Brokers. It's a platform, but the platform will allow you to invest in options. And we've created a SSAS that will allow you to do that as well. So in order to have a SSAS, which is a much more family-oriented pension aimed at business owners, you need to be a property owner or a business owner. And most people that we meet are. If you're an employee, it's probably not going to be won't be a SSAS that will work for you. But are there any SIPs that will operate that way as well? So for employees who want to do it, can they do that?
So, some, but they're not great. I mean, there are lots of restrictions. So, there are some SIPs that claim that you can do options through them. I would say a SSAS, all of our investors who have done options in a pension and have done it successfully, they've all been doing it through a SSAS. And of course, you can do options in your personal name, in your limited name, but you'll incur tax. But in a tax-free environment, a SSAS is the best vehicle for doing options.
And as I mentioned, we created, and we thought we had you in mind as we see what you're doing, that we created a very low cost, what we call a SSAS Lite offering that we don't promote generally, because we want to know they're understanding options specifically in order to do that. So anyway, we'll talk about that on another day, I'm sure, and we'll have some webinars on that, I'm sure, as well. So, by the way, if you like what we're talking about here, like and subscribe to Wealth Builders and Invest Like a Pro, which is Manish's business, and he'll talk a little bit more about that when we just ask him for his contact details if you liking the cut of his intellectual jib. Final point, we talked about at length now being in control, but what's the importance of being in control to share that wisdom with the next generation?
Oh, that's huge. That's huge. And, you know what it's like when you are sort of taking control, when you are actively making investment decisions for your own benefit and your family's benefit. There'll be, that kind of mindset flows through into future generations. And, I see it all the time. My kids, take an interest in investing, and my son, is kind of, he does a lot of, investing. My daughter's kind of, a little bit behind, but she will get there, I'm sure. And she's a bit younger, so she's got time ahead of her. But look, it's a huge thing. I think it's what more is valuable, right? So, what else is more valuable other than being able to pass on, financial wisdom to your kids? So, if you can be doing this as a family unit, if you could be sort of sharing decisions and making decisions collectively, or even thinking about investing collectively, I think that's a huge thing. It's a gift. I think it's a gift to be able to hand over to future generations.
And I agree with you, Manish. It's not just a gift on investing, of course, but gift in property, gift in a business if you've got a trading entity, because not that everybody wants to be a business owner or an entrepreneur, but in the end, my view of wealth and wealth planning is it's not about how much you leave, but how many generations that money can support. And the best way to do that is to teach wisdom and stewardship, not just spending, because there's so much anecdotal evidence of the way that assets in families sort of seem to dissipate over a few decades. And it's largely because of a lack of preparation, certainly from a tax point of view. People, IHT, for example, inheritance tax, is paid by unprepared families, and it's the kids who pick up the tab. And if you're a family member who's picked up a big inheritance tax bill that you've got to pay within 6 months, you're going to learn how to sell things pretty damn quick. You're not going to be buying much, and that's going to put you off investing and doing good things for the rest of your life. So, yeah, we're very passionate about helping people prepare, and not just about the inheritance tax, but of course about the wisdom for the next generation. So if people want to know about you, Manish, where would they go?
The best place would be to the website, investlikeapro.co.uk. There are lots of articles on there. We've got some podcasts, YouTube videos. I think you've been on one or two of them as well, Kevin. So yeah, we've lots of resources on the website there. You can just on the top of the on the top of the page, you can download an investment explainer and some videos. And I publish weekly insights, and so you can sign up for those too to get all of my sort of updated views and insights and articles.
Written by you, not AI.
Written by me, just me.
Well, good to hear. Thank you, as always, Manish, for sharing your wisdom. I hope that someone can take something away to help their own wisdom for their own wealth and for the next generation as well. And we'll put all the resources when the episode comes out, which will be imminently. So do like and subscribe to Wealth Talk, and then you'll know when anything is coming out. And if you like it enough, just let people know about it. Tell somebody else. Because in the end, we all have our exit, and we're all going to die, and we all need to protect and provide for the next generation as well. So until next time, everyone, see ya.
We hope you enjoyed today's episode. Don't forget that we are constantly updating our resources inside the Wealth Builders membership site to help you create, build, and protect your wealth. Head over to wealthbuilders.co.uk/membership right now for free access. That's wealthbuilders.co.uk/membership.